just recently, you actually raised your S&P 500 price target to 4,500, between 4,500 and 5,000. Now, that implies a 6% to almost 8% rise from where we're trading at right now when it comes to the S&P. What's giving you the confidence to raise your price target? What's the catalyst for this big upside move potentially?
Well, this week will be a good test of that thesis for two reasons. The first is, as you already mentioned, mega cap tech. So we think the AI boom could arguably take us really above fair value. But the other portion of our bullish call is that we think rates have peaked, which is non-consensus, really because we see Europe going into a recession this quarter. We'll get better data at the end of this month on both the EC and, importantly, Italy. Their economy is the weakest in Europe, and they have the worst budget deficit and the highest debt to GDP. So they're the weak link that could cause the ECB to cut rates as early as next year.
All right, so Jay, clearly you're looking at a lot of different macro factors. I want to bounce some research off you. This is from Ed Yardeni. He released it overnight. He says, in part, the escalation of hostilities we expect prompts us to raise our odds of a U.S. recession before year-end 2024 again, now to 35% from 30%. A year-end rally is less likely now, but geopolitical crises, they do tend to present long-term buying opportunities in stocks. So Ed Yardeni again out with a new note saying a year-end rally is less likely, recession odds increasing, but this could be a buying opportunity. Agree or disagree?
Well, I think there's a couple of elements that would be consistent with our thesis, which is there's two other reasons that probably the 10-year is peaking, or we think it's peaking. And that is that when rates rise so quickly, there is a response. So the U.S., both auto sector and housing sector are likely to slow. We don't think crash, but slow. The odds of a recession are higher. We still don't think there will be one. We have infrastructure spending as an offset. We do have the AI boom, none of which, by the way, are in Europe. So we agree the recession risks have risen, but we would still be buyers because those recession risks are likely to cool off the 10-year, which has been the key overhang on the market, particularly last week.
So you also believe that bond yields are pretty close to peaking right now, somewhere around 5%. So maybe not a buying opportunity when it comes to stocks, but what about bonds? In your mind, should investors try to lock in these higher rates?
Well, we think so, and that would really underpin our, if in fact we're correct about that, our target in the S&P. The other side of that, though, is important to note that every 40 basis point move in the Treasury implies, from a theoretical basis, a 1-point reduction in the S&P fair value multiple. So I would say that if we're not correct about rates and they don't rally, then our target is not going to be reached. Should probably be closer to our original target, the beginning of the year, about 4,500, because we do think the tech earnings will be strong. But rates are really key, not just to the bond market, but also the stock market.
All right, Jay, one other quick question, if you don't mind. Looking at the Dow futures right now, moving lower since we've been talking. We've seen a trend of Europe opening lower, and then it obviously hits the U.S., or not obviously, but it tends to hit the U.S. markets as well. What do you think's the reason for those mechanics? As you mentioned, two very different markets in Europe and the U.S.
Well, we think that it's not just Europe stocks opening, but also bonds. It's a world bond market. And if you look right now, the world bond market's off slightly. So I think that's really the driver, is not so much stock prices in Europe. European multiples are depressed. They're about 10 times earnings. They already reflect this negative outlook on the economy. But their bond market is really driving our bond market, which is driving our stock market.